Lenskart is finally going public, and the headline everyone is talking about is their 70,000 crore valuation and a price to earning ratio of 235. To put that into perspective, even Nvidia, the company powering the entire AI revolution, trades at a PE of around 60. So the question everyone is asking is, how does an eyewear company in India deserve a higher valuation multiple than one of the fastest growing tech companies in history? And more importantly, is Lenskart's IPO a sign of India's startup maturity or the next Paytm moment waiting to happen? Welcome to our weekly Indian startup news show. I'm Pankaj, your host, and you're watching Backstage with Millionaires, a channel that's also part of Zerodha's 01 network. Now let's rewind a bit. When Paytm went public in 2021, it was supposed to be the IPO that would change India's tech ecosystem forever. It had a massive brand, huge user base, and global backers. But within days of listing, the stock crashed, wiping out billions of dollars in investors' wealth. Why? Because the company was too overvalued, and the numbers did not justify the stock price. And that's exactly why people are cautious with Lenskart. Because just like Paytm, it has a strong brand, big dreams, but its numbers don't justify the valuation it's asking for. Let me explain how. See, Lenskart is raising around 7,200 crore rupees from its IPO, but only about 2,100 crore rupees of that is new money coming into the company. The remaining 5,100 crore rupees is what's called an offer for sale. Basically, existing investors like SoftBank, Temasek, and Premji Invest are selling their shares and cashing out. That means when you buy Lenskart's shares, a big chunk of your money is not funding Lenskart's future growth. It's funding someone else's exit. And that's usually not what you want to see in a company going public at such a high valuation. Now, to be fair, Lenskart is a strong company. It has built India's largest vertically integrated eyewear brand. They design, manufacture, and sell their own products through over 2,500 stores in India and dozens abroad in markets like the UAE, Singapore, and Japan. And unlike other D2C brands that rely on third-party suppliers, Lenskart controls the entire value chain, which helps them with consistency and margin. In terms of its financials, in FY25, Lenskart reported a revenue of 6,652 crore rupees, up from 5,427 crore rupees in FY24. Also, it posted a net profit of 297 crore rupees after a loss of 10 crore rupees in FY24. Now, this may look impressive, but there is a hidden detail that not many people are paying attention to. A part of this net profit comes from what's called other income. It's not part of the company's core business. And in this case, Lenskart earned 167 crore rupees as one-time fee from one of their past deals. And if you remove it, then the actual profit would be much less. Then there is this another thing that many people are talking about. Just a few months back, Payush Bansal, who is the founder and CEO of Lenskart, bought 4.27 crore shares from existing investors. But what's interesting is he bought these shares at an average price of 52 rupees. And today the value of Lenskart's unlisted shares is 510 rupees, which means Payush Bansal got these shares at almost 1/10 the price of its current value. And this raises a tough question. If insiders are buying shares at 52 rupees a piece, why should retail investors buy them at 10x of that same value? Now, of course, one thing to note here is that founders buying back shares before an IPO is not something unusual. A lot of people do it. Swiggy's CEO did it, and FirstCry's founders did it too. It's often seen as a way of having skin in the game before going public. But in this case, the gap between what insiders are paying and what the public is being asked to pay is unusually large, and that makes this IPO even more polarizing. Now, Payush Bansal has defended this high valuation by saying that this is not just about eyewear, it's about building a category-defining company. He says that the market is valuing the company based on its potentials, not just past profits, and that's not entirely wrong. See, India has nearly 500 million people who need corrective eyewear, but only a fraction of them actually own one. So the growth runway for Lenskart is huge. Also, the company's tech integration from AI-powered fittings to AR try-ons has also made buying glasses easier and cooler for a younger audience. And globally, Lenskart is expanding aggressively with stores in the UAE, Singapore, and even the US. So yeah, it's a strong business, but does that justify paying a 235x earning? That's the real debate. Let me know in the comments what you think. Alright, next up, Bira91 just lost control of the beer Café, one of its most successful and profitable business. And this wasn't a sale, it was taken over by its own investors. Let me break down what's exactly happening. See, the beer Café, which runs over 40 pubs across India, used to be a subsidiary of Bira 91's parent company B9 Beverages. And this subsidiary that runs this cafe is called Better Than Before. Now, to raise funds, Bira had pledged the shares of Better Than Before as collateral for loans that it took from Anicut Capital and Japan's Kirin Holdings. But when Bira could not pay its loan back on time, these investors invoked their rights and took control of those shares, effectively taking over the beer cafe. Now, naturally, founder Ankur Jain wasn't happy and he moved to the Delhi High Court, calling the move illegal and saying that the lenders had gone against their contract. And the court has since issued an interim order stopping the investors from selling or transferring those shares until the matter is resolved. But according to Rahul Singh, who is the founder of the beer cafe, this is not a hostile takeover at all. His argument is that the cafe still operates independently under the same leadership, but it's now backed by institutional investors and not Bira 91. So, who is right? To understand that, we need to look at how Bira 91 ended up here in the first place. This all started back in 2023 when Bira was forced to change its legal status from a private limited company to a public limited. Basically, it had crossed the 200 shareholders limit under Indian company law. And that small legal technicality created a massive problem. See, the moment it changed its name to B9 Beverage Limited, every state in India treated it like a completely new company, which meant it had to reapply for licenses, permits, and product approvals across India. And for almost 6 months, Bira was not allowed to legally sell beer in several states. Imagine being one of the fastest growing beer brands in India and suddenly being unable to sell your own beer. And that single disruption triggered a domino effect. Sales crashed, revenue dropped, and the company had to borrow heavy money just to stay afloat. It raised over 600 crore rupees in debt, and much of it came from Kirin and other lenders. And the company even started issuing shares to creditors to settle dues. And by FY24, Bira's revenue had fallen 22% year-on-year to 638 crore rupees, while their losses grew 68% to 748 crore rupees. And as a result, investors grew anxious, employees began complaining about delayed salaries, and there were reports of even removing Ankur as CEO. So this beer cafe takeover is not an isolated event. It's a direct result of that long financial struggle. Also, it shows that how quickly control can shift when founders pledge assets to raise capital and when growth starts collapsing under debt. Alright, moving on to some quick news updates. Continuing to talk about IPOs, Boat, Curefoods and Milky Mist are the latest to move forward with their public listing plans. Firstly, Boat has trimmed its IPO size to 1500 crore rupees, which includes a fresh issue of 500 crore and an offer for sale for 1000 crore rupees by investors like Warburg Pincus, Fireside Ventures and Qualcomm Ventures, along with co-founders Aman Gupta and Sameer Mehta. Meanwhile, Curefoods and Milky Mist have also received SEBI approval for their IPOs, with plans to raise 800 crore rupees and 2035 crore rupees respectively. Alright, next up, Ola Electric has received ARAI certification for its in-house 4680 Bharat Cell, which is a key step towards powering its own scooters with their Made in India battery pack. The certified 5.2 kWh pack will first appear in the S1 Pro Plus, making it the first EV to use Ola's homegrown cell. At the same time, Ola is opening up its service network, allowing independent garages and local repair shops to access spare parts, training and diagnostic through an open digital platform. And this means that anyone, not just Ola's own centers, can service its vehicles, which will help it to expand reach, cut waiting time and lower maintenance costs for users. Next up, manufacturing platform Zetwerk has filed a lawsuit in a Texas court against its former executive Anirudh Reddy Edla and his new company Air Energy, accusing them of stealing confidential data and poaching clients. Zetwerk has claimed that Anirudh downloaded hundreds of sensitive files, including customers list and pricing data, before quitting in early 2025. And Zetwerk estimates that they lost around $77 million in potential orders. And the company is now seeking $100 million in damages and an injunction to stop Air from using its data or soliciting its clients. Alright, now let's move into the funding news segment for today's video. This week, Indian startups raised a total of $100 million, which is significantly higher than last week's $18.4 million. And now let's look at some of the companies that have raised funds this week. The first one I want to talk about is Mumbai-based quick home service startup Snabbit. Think of them like urban company but quicker. And they've raised $30 million in their Series C round, valuing the company at $180 million. Following that, we have a Bengaluru-based fintech startup called Optimo Capital. Optimo Capital was started by one of the founders of Ease My Trip founder Prashant Pitti. And through Optimo, he's making it super easy for small business owners to get big loans by using their own property as collateral. So instead of waiting weeks for a traditional bank to process lots of paper and approve a loan, with Optimo they can just upload their property papers online, and their tech uses AI and digital land records to verify everything really fast, sometimes giving the in-principle approval within hours and disbursing the loan in under a week. And they have raised 150 crore rupees or $17.5 million in their Series A round. After that, we have New Delhi-based Suyu Manufacturing, a company that builds the heart of electric vehicles, the motors and powertrain systems that make the EVs move. Think of them as the behind-the-scenes tech team that supplies electric motors and controllers to companies making electric rickshaws, trucks, buses, tractors, and even off-road vehicles. And they've raised $4.5 million. Next, we have a PropTech startup called Open House, which is transforming the experience of buying a resale home, making it as seamless and stress-free as possible. Basically, instead of just connecting buyers and sellers, Open House carefully handpicks homes, fully renovates them, fixes home problems like leaks, and even stages each property so it looks beautiful and move-in ready. They take care of all the legal paperwork and offer a 1-year warranty for extra peace of mind, so buyers don't have to stress about hidden issues or surprises. And they've raised $2 million in their seed round. And finally, we have New Delhi-based climate tech startup Beyond Renewables, a company that's tackling one of the biggest environmental blind spots. Basically, what happens to old solar panels when they are no longer useful. So instead of just installing renewable energy systems, Beyond Renewable goes a step further by providing high-tech recycling and circular economy solutions for solar waste. And they've raised 5 crore rupees or $560,000 in their pre-seed round. Alright, that's all the startup news I have for you this week. Thank you so much for watching, and I'll see you in the next one.